We were talking earlier around the Fed and Europe, and you had some comments coming through, and you basically said it doesn't matter that they go one or two. We're near the end of the cycle, the tightening cycle.
Yeah, I think it's that they are near to the end of the tightening cycle. And the important thing I want to emphasize that the Fed has been in what we call a risk management kind of mode of operation since November last year. And the key thing is, I think if you look at the minutes from the last November meeting, and they make a very clear message that fighting inflation is not the only aim. It's not the only goal, and that actually is very important to assess whether they have been doing too much or doing too little. At that time, they start mentioning about the risk of a slowdown, and they're not sure yet. I mean, the staff gave a report saying that, okay, maybe, but the officials, the voting member, certainly did not say there's a risk of recession at that time. And then the second thing, they also mentioned the risk is financial stability. They actually mentioned about they need to watch financial stability back in November. So that's actually from all the way from November to now, they are managing the risk to balance the risk of fighting inflation being sticky, and at the same time, whether there's the economy slowing down more than they want to see. They definitely want to see a slowdown, but how much? And there's also financial risk, financial stability. So this, if you're from yesterday's statement, they're talking about the same thing.
Talking about financial stability, and I have to wonder, just all the concerns that we had about the Treasury replenishing its cash and its coffers, and whether we are going to see that sort of liquidity crunch. Have we seen any signs of that?
I think for the data we have seen so far, that's up to the 14th of June, and we'll be seeing new data tonight. And actually, that concern is a little bit overblown. In fact, liquidity has not really come down in the banking system. And why is it so? Because it's when, yes, the Treasury increased the cash balances in what we call the TGA, the Treasury General Account at the Fed, so taking money out of the banking systems. There's about more than 80 billion since the beginning of the month until the 14th of June. But at the same time, a lot of those issuance, actually the T bills, they were all bought up by the money market fund. And the money market fund, they have two major investments. One is T-bills, one is the reverse repo at the Fed. And so they actually reduced the investment in the reverse repo with the Fed. That's paying, they are getting 5.05, but in the T-bills they are getting 5.11 to in terms of yield to 5. Depends on the maturity up to 5.5. So they are happy to buy more T-bills and reduce the reverse repo. And so the reverse repo actually the balance came down more than 140 billion. During the 14 days. So that's more than offset the increase in the TGA. So in fact, the banks reserve at the Federal Reserve System actually increased by about 100 billion. So during that period of time. So we have not seen any this kind of liquidity crunch. But of course, we need to see more tonight, tomorrow morning our time. Yeah.
So in very simple English, what does that mean for risk assets?
That is actually help to reduce some of the risk of the risk off. So that is actually help the notion of risk on because the liquidity is still in the banking system. Yeah. So the money is still in the banking system, haven't really get away from the banking system and back to the Federal Reserve.
Fantastic. Yeah.